Back with the market, and what a market this is turning out to be it the Dow futures, irrespective of that Fed move, or for that matter, our markets. By the way, some other Asian markets, Japan, for instance, has seen a recovery. Those markets have nudged back into the green, but no respite for us. While we may not be at the lows of the day, which was a cut of 6%, but we're still down 450, so not really a respite in that sense. IndusInd, RBL Bank, Piramal Enterprises, ICICI Bank, Titan, PVR, Sri Cement. It's a long list of losers, and these are double-digit cuts that I'm talking about. Manish Chokhani joins in the show right now. Manish, hi, morning. This is just sheer panic on the screen. What's been your reading? I mean, the chatter that we're picking up is that this is FII selling. Domestic guys are still holding on to their positions, but it seems like that's also sort of testing your patience right now.
Yes, Aisha, it's right. I've said elsewhere that, what you're faced with this time is a panic, and the panic is kind of exacerbated by the fact that computers now rule global markets. We have 80% of all global trading which now takes place with algorithms as well as by computers. And we've spoken in the past, even in your interviews, about the fact that we now have what we would call price agnostic funds. So when money comes into these funds or ETFs, they are basically agnostic and they keep buying the same stocks. So if you'll recall, a couple of months ago, we were finding it odd that 10 or 15 companies were leading the index higher, whereas the rest of the market had been completely decimated. This seems to be the reverse of that now playing out. That if the tick is down, the computers and the algos are going to keep selling, and if the word of panic continues in the West, the computer doesn't know that mathematically this should have been a bottom. It's going to probably just keep selling. So it's interesting times if people have gunpowder, and if they are not leveraged. I would just urge, obviously don't go and invest your last dollar today. Wait for that one uptick. But at some point, these valuations will be so mouth-watering that a lot of the wealth creation that people hope for will actually occur in these times. From the bottoms that we are hopefully creating as we speak.
Sure, that's in retrospect, Manish, and I hope that a few months down the line we'll be like, wow, what an opportunity that was, and this too shall pass eventually. But just staring at the screen right now, many are saying that the high global debt that the US companies are sitting on was waiting to meet with an incident like this, and the coronavirus has given it that opportunity for this bubble to burst. Do you think the panic has just about begun when it comes to some of those US sought after FANG names and those high market cap companies?
So Aisha, I don't think it's right to generalize. I've been one of the people who've been speaking a lot about the global indebtedness, and the fact of the matter is that the world is running on a debt to GDP of close to 3.5 times, and that debt levels are unsustainable. Having said that, companies, which is what we are focused on when you have to buy them, and you always bet on the fact that mankind will survive. This is not an extinction level event. And if you looked at the companies in the US, whether it's the leading FANG stocks which are generating cash by the bucket load, or you even look like at someone like Berkshire Hathaway, which last when was reported was close to $130 billion of cash. So it's not like everyone is indebted. Similarly, if you turn back to India, it's not like all investors here, including ourselves, had any leverage. In fact, a lot of us were sitting on substantial amounts of cash, not anticipating this event, but just generally because there was nothing very interesting to do given the prices in the market. So I think you will find, water will find its own level. And in times like this, when daily wage earners or the marginal companies don't have access to, cash flows or liquidity, it's not unusual to find that, 10-15% of the bottom rung will get eliminated. And that's really what the governments in the West are panicking about, because that's how, say, Hong Kong is sending $10,000 to per citizen. That's what the US is trying to do by putting in zero interest rates to extend the credit card cycle or the indebtedness of a lot of the sort of marginal borrowers in the US and the companies. But honestly, if you were paying 1% interest and now you're paying zero, it's not going to move the needle for you as a business. The fact is, if you're over levered, you're going to be in trouble one way or another. And like you said, this is just one excuse to kind of tip those companies over. And in the old kind of parlance of Adam Smith, this is invisible hand of the market playing out for people who shouldn't have been doing things that they're doing anyway. So at one level, it kind of creates, how do you say, assets moving into stronger hands and creating more durable kind of foundations to what eventually will be the next rise in the market. And like you said, this too shall pass. And if you're not levered, actually your mindset should be oriented towards looking for what do I really want to buy with my last 5 or 10% cash which I have. And if you're looking for that rather than looking at the screen and panicking, I think these could be really interesting times for an investor.
You know, I was just wondering about, while of course this is a time that one should be buying, and you know, one knows that one has kept the powder dry because it was in any case those 10-15 names which were doing the work in the market for the last year and a half, Manish. But given that this has been sort of the fastest bear market in the last 1.5 months, we've turned from the peak of a bull market, so to speak, in terms of an index level, now to the bear market territory, a shave off of 20% from that peak. What does it tell you about the market emotion cycle per se? Are we at the bottom of the panic? Is it the beginning of the panic? Where are we?
No, it's certainly not. I don't think this is bottom of the panic because the way, say, the Asian countries have handled the pandemic, including China, you haven't heard of that number moving from 80,000 cases from China. And even if you don't believe the stats coming out of China, the way Korea has handled it, or the way Hong Kong and Singapore have handled it, having had the experience of SARS, you know, close to 10 years ago, has been incredible. And contrary to what our belief is that the West is very, very well geared up, I don't personally think the US is handling it well. I don't think the UK in particular has gone for what they call herd immunity, which is do nothing, let the herd kind of self-immunize and get vaccinated, and so what if a couple of people, you know, fall by the wayside. I think the panic is going to come this time largely from the US and UK because they haven't actually, I think in my view, handled it well. And that oddly will create an opportunity because the panic is not going to be subsiding at the same time across markets. Like if you now speak to people in Korea and China, they'll sound a lot calmer than the friends I speak to in New York or Boston, where literally there's a state of panic over there. They've also just reduced their high testing prices in the US only recently to 0. So while markets were very focused on, you know, interest rates, the real problem was they didn't have enough testing happening in the US. There was no checking going on over there and so on. So, you know, it's going to be a rolling and evolving thing. I don't think you find one fine day someone will put up a green light and say all is over, because markets would have already moved by that point. But if you're asking me, is this today the bottom of the market? I don't think I'm God, and I don't want to play God and say I'm making that call today. And it certainly doesn't feel like 100% capitulation on a global basis as yet.
Sure. You know, I don't think anyone can really call a bottom, and it would not even be wise when everything's falling like 9 knives. But Manish, is this the time to buy? What is the valuation telling you right now? Should you start nibbling in, or at least drawing up that list, if not nibbling in just yet?
Yes, Aisha, the way I think about it is really 4 stages, and it's not like everything will follow that exact pattern. So number 1 is you want to be in impregnable businesses and leaders in this period. And I'll give you an example. That if, for instance, you were to think 2-3 years ahead, who are the winners of the Indian sort of banking landscape, as an example? You know, the top 5 players, SBI, HDFC, ICICI, Axis, Kotak, are going to be around, and they're going to be far, far stronger. Are the valuations for a lot of these names, maybe not all, but a lot of these names are very, very attractive. Will the prices get even lower? It's possible. But do I want my pencil sharpened and be ready so I can deploy my last 10% cash over there? Answer is yes. Do I know that I can do all 10% on the same day, or should I be doing it, you know, as nibbling bites of 0.5%, almost like a systematic investment plan over the next 20-30 days? Answer is yes. Similarly, you look at other businesses. So while, say, tour operators and others are impacted, what happens to people who are now staying at home? Your own business, for example, in the media, are you not sitting at home and watching a lot more of television? And is that not an opportunity for these players who are also now consolidating? And don't you also feel that the money runs out for all the freebies which were being given to people to consume media for free? So a lot of people will come out very, very strong beneficiaries of this down cycle today, as opposed to the panic which is kind of hitting everyone with the same brush. So I would say category one is people like that who come out well over the next 3 years from this crisis. Category two, for sure, will be the world will now say, I want to diversify my sourcing base. And there are a number of players in India, whether it's in chemicals, whether it's in textiles, who I presume will be large beneficiaries of this. And they may have a terrible next 3 to 6 months as people are not able to ship product from their factories, or people don't unload at the ports on the other side. And those will create mouth-watering prices. I think some of them are already there, and in some of those we've already been dipping in. So that would kind of be category two. In category three, you would still have the large the public sector companies, which at some point, if the government is able to get this BPCL and Concor and Air India going, at some point people will realize that these assets do have value. Maybe they haven't been run most optimally in the past, but when you go back 15, 20 years and you see the value created by the likes of Hindustan Zinc, if you were there at the moment of maximum pessimism, as seems to be happening today to these PSUs, and they go into good hands, and in fact, I'll draw the analogy of what's happening currently with Yes Bank, that you've gone to point of maximum pessimism, there is a restructuring in place. What could happen to this company over the next 3-4 years could be interesting. I'm not suggesting anything about that bank, but making the point about PSUs, also making that transition from sort of governmental hands to stronger hands, and is there a rate of change possible over there? And the fourth category, which will certainly at some point come back very strongly, is commodities, because the way they have collapsed, the supply chains are all empty, the commodity prices have collapsed, their multiples have collapsed. When they do come back, these prices will go back to being what is the 85th percentile producer's cost. And at that level, and going back to what you would call regular multiples, the valuations could be 3x, 4x from here. So all these are kind of interesting places to start looking at. And I have limited amount of capital, but I'm a private investor. I don't answer anyone. I don't have to look at daily NAV. So it's a really kind of mouth-watering opportunity and kind of really exciting time for someone like me.
Right. Manish, I want to pick up on all these individual cases one by one. And first on the point that you were making about disinvestment, yes, Hindustan Zinc has been a great historic example, and now those who put in money are laughing their way to the banks and done and digested with that as well. But don't you think in the current environment, disinvestment is going to be a tough ask? We've all seen how long the government has grappled with Air India. BPCL still pretty much seems to be WIP, a work in progress. I mean, a perfect example being, look what's happening to the SBI cards listing today. What started off with the grey market premium of 350 shrunk to 5%, and now it's listed even sub its issue price. This kind of market environment would also derail things, don't you think?
Yeah. I completely agree with you, Aisha, and that's why I said I see it happening in 3-4 phases. And phase one was therefore the market leaders might get to such lucrative prices that if you had asked me a month or 2 months ago, do I see HDFC Bank at 1,000 rupees? My answer would have been no. The fact is it's today 1,000. Is it heading even lower? Possibly. Do I want to keep my money, waiting for that, or do I want to jump in and buy what I would call stage 4 commodity producer today? Answer is I'd much rather buy the better quality business at a better price, because then I don't have to sell it presumably for a very, very long time. So I just mentioned the 4 categories as places to look for, because they're going to get very interesting. And while I agree with your assessment of the impact today on the divestment program of BPCL and so on, that if Saudi Aramco itself has announced very low results, maybe they don't get as aggressive in bidding and so on. But at the point when these companies are sold, and I presume it will take 3 months longer than people anticipated, and therefore the prices will start reflecting that uncertainty, it gets to valuations which become so compelling that frankly that a deal is going to happen here because the backs are to the wall. And when that deal happens at that price, I better be there rather than worrying about oh, it's never happened in the past. For 3 years they've tried and it haven't happened, or the prices is not what they expected, because I'm getting that same price as well. So all I'm saying is, let the mind be now geared towards looking to buy rather than looking to sell, because the bulk of the fall is now behind us. If you were a levered player, you're already cleaned out. If you're a ETF or an emerging market fund which is being forced to sell, you have no option but to sell. At that point, there have to be buyers like ourselves who are standing here and saying, okay, what can I cherry pick from this great buffet table which is being laid out in front of me? That's all I'm trying to communicate. By no means am I saying you can go and buy everything today or at today's prices, but if my homework isn't ready for all these companies and at prices that I never honestly imagined, even a month ago, I would be doing myself a disservice as an investor. And the last thing I'm saying is, it's the last 10% cash. It's not like 90% of my portfolio hasn't suffered. But those portfolios are companies which, I'll draw the analogy like with my home. If I stay in a lovely location and I don't want to move out of that location, and I know what the value of that location is going to be, do I sell that location just because someone else in the building went bankrupt and therefore I should also get out while I have a chance? Or I say, no, I get a chance to buy another apartment in the building at these distressed prices. So that's really the analogy I'm trying to draw.
And all of those tick boxes stand corrected. You do live in a lovely location. But anyway, getting back to stocks. So, Net and Manish, for our retail investors who are watching right now, you're saying start your homework with buying more of the same, the safest quality names, the HDFC Twins, the Bajaj Finances, which have proven records of being great compounders in history. Is that largely what you're trying to say?
So I'll say two things, Aisha. Number one, I hope the asset allocation is correct for most retail investors, because they are not the same as we guys who do this day in and day out. So if your allocation to equity is okay, there is no reason to get scared out of equities. In fact, long term, this is the best source of wealth creation that you can do. If you had an SIP and you were doing maybe 10-20% of your net worth in equities, I would suggest rebalance, look at what the portfolio would have become based on the valuations now, and get back to the right balance, which means you would step up your buying of equities at this point rather than less. Number two is, while all the businesses are great, and I don't want to dispute the names, but I've personally benefited from them, but the valuation of a great business, if it's reflecting that, it may not be the best buy. All I said was, as long as I know these 5 guys are going to be around, and I would submit 3 of these 5 have fantastic prices already, maybe not yet the other 2. If you get those at prices which become mouth-watering, where everyone gets aligned on the same side now, there's almost no one to argue against the price or the business. That's really the point of maximum pessimism when you can buy. When people are just begging each other that please buy this because there's no buyer left over here. And I think we are getting there. It's a matter of time. And as a retail investor, all I would say is continue SIPs and step it up if your allocation to equities is not enough. And I'm sure the fund managers with whom they are investing are smart enough to figure out which are the right businesses at the right price. Like Warren Buffett often says, you pay a high price for a cheery consensus. So if you're getting a cheery consensus on some names being great businesses, the prices may be already reflecting it. Whereas what I'm arguing is a good business at a great price is a lot more valuable than a great business at a great price.
Sure, absolutely. And given the way the market is falling, some of those great businesses also will come to lucrative prices, I'm sure. On the subject of commodities, Manish, I'm assuming you're talking about metals and buying the distressed in select companies, is it?
So it will happen across the board, Aisha, because remember, over time commodities tend to get to prices which reflect the marginal level of production, and normally a commodity will tend to have more supply than demand. And I've seen over cycles and cycles over 30 years that normally the 85th percentile of production capacity is where the price settles. So in a lot of metals, as an example, since you're mentioning that, prices are probably at 45th percentile today. So these prices are not sustainable, and a lot of capacities will get taken out in the world. And today is not the time when you can predict what the prices will be, because there is really no buyer for anything today. But when this demand does come back, as it inevitably does, and it may take 3 months, it may take 6 months, these prices would gap up back to what I would call the 85th percentile of cost of production, which from today would imply a lot of these metal prices could be 50, 100% higher. And at that point, the multiples which you are assigning today, which are also depressed, would also kind of regress back to mean. And it's in those periods you get literally what we call 4 and 5 baggers in this. Having said that, it's not for the average investor. It's not something that you should be doing right now. But the prices are certainly going to be very, very lucrative to create an enormous amount of wealth. A lot of large producers are also likely to kind of go belly up because a lot of them have leverage as well. So this is not a game for the faint-hearted, but it's certainly an area to start looking, because it's like how Blackstone would say this is, the black swan event where you get assets in distress at throwaway prices. So very similar an analogy to what's going to happen with the public sector also in the current downturn. But very interesting place to look. Also, I don't bet on oil being $25, $30 forever. So there will be opportunities over there as well arising from that.
Sure, interesting times. But just on the analogy, Manish, that everyone's drawing this as a comparison to what happened in 2008, without realizing that 2008 was a man-made catastrophe. You could engineer a way out of it, and this is a natural calamity in that sense. You don't know the extent of it, even the virus is unknown. Do you think that there could be more a grinding process out of this calamity, as opposed to what happened in 2008 when you had the US government come and rescue the entire world, so to speak?
Right. Yes, I would tend to agree with that the world, for sure, and certainly I had this theory on India as well, that our growth rate was not going to rebound in a hurry. For two reasons. Number one, nobody in his right mind in India wants to go back to the glory days when they thought if I put up a project, 2:1 debt equity is the norm. First of all, those projects used to be padded on capital costs. Number two, 2:1 debt equity in a high inflation economy with no one kind of being answerable to anything was the norm. I don't think those days are there anymore. And therefore, your organic rate of growth really comes back to what your ROE is, plus what moderate amount of leverage you might want to apply to that business. But certainly if the country is now not going to take 2:1 debt equity leverage to grow, and it may be at 0.5, automatically it implies that the growth rate is going to be a lot slower. Number two, the profit cycle still hasn't come back, and what used to be a 6-7% profit to GDP ratio is currently probably south of 3%. So that also gives you the amount that you have available to reinvest is very, very low. And typically you find in phases like this, which I call this as kind of phase 6 of the market, where it's a complete bust and everyone is trying to throw money and find a solution to the problem, and nobody wants that money. You typically will have to get one sector or one regulatory change which will spark a kind of profit revival, and people will kind of be dismissive about it and not believe it. It's only from that first batch of people who make the money that the kind of optimism starts spreading to their suppliers, their customers, their employees, their shareholders, and so on. And then the profit boom kind of multiplies, and then the P expansion takes place. So in this phase 6, it's not a period like 2008 where the financial crisis gets over and we get back to life as normal. In this particular episode, I think the recession in that sense starts from the real economy and starts impacting the financial markets, because if people aren't going out, they aren't buying stuff. It's not like the recovery is around the corner in 1 week or 2 weeks. It's probably this quarter is gone for most companies in terms of earnings. It may well linger into next quarter, but financial markets have already started pricing that in, and the fear is that this is going to linger longer, and that's the bet I'm kind of taking, that this doesn't linger for as long as people expect. It plays out faster, but then the recovery is certainly not a V shape for the real world. And even for financial markets, I would much like to see a W with a kind of double bottom being in place and stronger hands absorbing the stock before you can see a more sustainable uptrend. And that's really the best guess I can make today.
That's a good one at that. But, just Manish, one word. The RBI is being ridiculed at this juncture for not being proactive, being the being behind the curve, not moving at all on rates. Overnight, we've seen the Fed cut rates to 0 and still the markets are down. What would the market as a fraternity like to hear from the government or from the RBI at this point in time? You know, many are saying that why can't the SEBI come out and ban short selling as well, like they've done in China, which has sort of arrested their market fall?
So, well, I don't like making policy prescriptions. I'm not qualified to doing it. And I just mentioned, while we ridicule our regulators here, cast an eye on the US, where maybe the Fed, after a long time, is ahead of the curve, but their healthcare systems, certainly in my view, are behind the curve, which is where the real problem is. So because they're so used to solving financial crises, they've forgotten how to probably solve real world crises over there. I think for once, the Indian health authorities have reacted very well. They are very ahead of the curve in stopping people from coming in from other countries, including from countries which we would have never imagined them banning flights from Europe and so on, or not having those visitors come in. And as far as the regulatory forbearance in India is concerned, give the guys a break. They've just kind of gotten out of the Yes Bank mind space. Maybe you get something this week. And having said that, I don't think there was a problem of liquidity or rates in the Indian market the way it was in the US, where their credit markets were kind of seizing up because of liquidity. There is excess liquidity in the Indian system. And even if you do a 100 basis point cut in India, it's not like people are falling over themselves to take money. And the marginal buyer in India, remember, is not actually really still in the banking system. So what you probably need help is in the microfinance and the sort of agri distress or the MSME space in India, rather than necessarily in the large corporate space. But I'm sure these guys are, thinking about it. They'll come out at the right point. While there have also been some noises about why has the government used some of the petrol price hike to build up its balance sheet, we can't really have it both ways, that we want the government to come with a fiscal gun and a bazooka at some point, but we don't want to give them the leeway of taking away some of the gains that they've got from this $30-40 billion bonanza from the fall in oil prices. So I'm hopeful that, like most times, doing the wise thing rather than the fastest thing is probably the right way to go. And I remain hopeful about our country does find a way eventually.
Yep, slow and steady wins the race. And I hope, Manish, that 1 month down the line when we're talking, things are looking different and that W recovery is very much in place. But great to have you on the show. Thank you as always.
Thanks for having me. Thank you.
Okay, sound piece of advice coming in from Manish Chokhani on a whole host of, topics ranging from what investors should do, where and when he sees the recovery coming in for the markets. For now, that seems to be completely evading us. We're still at 94.41. We're still lower by 450 points. And the breath continues to reel under pressure. So no sign of a recovery, at least as of today. We'll wind it up then on this edition of The Market. Thanks very much for watching.